Imagine this, it's 6 months from now, mortgage rates have finally dropped, and suddenly the home you wanted is $50,000 more. Because here's the thing, once rates dip below a certain line, the entire market is going to wake up, and if you're just sitting on the sidelines waiting for the perfect moment, you're going to miss it. And that's because the market doesn't wait for you to feel ready. In today's video, I'm going to show you why we're approaching a moment that buyers will either capitalize on or end up regretting, depending on the decisions they make right now. In fact, we're going to break down where I believe mortgage rates are headed throughout the remainder of 2025 into 2026, what the Fed just signaled without saying it directly, and what you should be doing right now to stay ahead of the curve. If you're trying to buy, sell, refinance, or just make smart moves with your money, then this is a video you don't want to miss. So before we talk about where rates are going, let's talk about where we're at the moment. The 30-year fixed mortgage is sitting somewhere around 6.25%. Now, I realize that's not amazing, but it's a big step down from where we were. Back in October of 2023, nearly 2 years ago, we were over 8%, which is essentially the peak. And then earlier this year, we started in January with interest rates over 7%. But here's the best part. Now we're in the low sixes with a lot less volatility, which means it's a little bit flatter and a way more stable trend. At the time we're filming this video, the 10-year treasury is just under 4%. And while inflation is cooling, unfortunately, it's not completely in the rear view, which means for a lot of first-time homebuyers out there that are still trying to make it work, affordability is still really tight. But here's the upside. We finally have some stability in the market, and that's what gives you the ability to plan instead of react. Now, before we talk about where interest rates are going, I'd like to take a minute and ask a favor. If you find any value in my videos at all, make sure you hit that thumbs up and do me a favor and just smash, obliterate that subscribe button to stay updated on everything real estate related. So now let's talk about where interest rates are going, because here's the thing, and part of the problem, the experts out there don't agree. They're looking at the same data, but they have very different takes. So I want to walk you through the key voices out there in the market, starting with the Mortgage Bankers Association. In fact, they see mortgage rates staying in the 6% to 6.5% range all the way through 2028. Realize that's 3 years from now. And that's because they're focused on sticky inflation, the high federal deficit, as well as a 10-year yield that they think is going to stay elevated. Their message is really simple. They're saying don't expect 4%, but rather build your plan around 6%. So in layman terms, the Mortgage Bankers Association essentially thinks rates are going to hang out more or less where they are right now, with the potential of trending a little bit higher. And then we've got the Fed. Recently, Jerome Powell said the Fed is nearing the end of quantitative tightening. And this is huge. His words said, we may approach that point in the coming months. So the translation is that the Fed's not hitting the panic button, but they are preparing for a shift. Here's the thing, if QT ends, quantitative tightening, if it actually ends, that means liquidity in the market improves. If the 10-year yield drops, then mortgage rates are likely to follow. And this is exactly the setup that Barry Habib's been waiting for. Barry believes that rates could gradually trend into the mid-5s by late next year. Now, here's the thing, I've said it time and time again, it's not going to happen overnight. It's going to be a gradual grind lower. Now, his reasoning is that he believes inflation is easing, especially when it comes to shelter costs. And at the same time, he believes the Fed will cut, mortgage-backed security spreads will tighten even further, and that the 10-year is likely to stay below 4%. Now, here's the thing, he's not promising 3%, just a path toward more reasonable money. In fact, his quote is, we're on the verge of a meaningful improvement once the data catches up to reality. But he also warns, if inflation rebounds or debt pressure stay high, that path could stall. Which leads me into talking about Logan Motashami, which is one of the analysts I probably quote the most on my channel. And his whole thing is watch the data, not the drama. Now, Logan's somewhere in the middle of the forecast that we've seen so far, calling for rates to trend somewhere between 5.75 and 7.25, depending heavily on Fed policy. Now, I think it's important to note that Logan has had the same forecast for about the last 18 months or so. Now, as you notice, he picked a range, and that's because he doesn't actually forecast a specific interest rate. But what I'll say, out of the 4 people I've quoted today, Logan, in my opinion, has been the most accurate. So with that, he sees the 10-year yield anchoring rates somewhere around 6%, which is essentially where we are today, unless something breaks lower. But what he's really watching is buyer behavior. When rates dipped below 6.6%, he saw demand surge. Builders got more confident, inventory slowed. So his message is that the economy is softening, it's not collapsing, and that you need to follow the data, not the headlines. And the last person we're going to talk about today is Lawrence Yun, who is the chief economist from the National Association of Realtors. He believes that 6% is the new normal, give or take, and that buyers should stop waiting for the past to return. He believes that recovery will come from rising inventory, not super low interest rates. So what does this actually mean if you're a buyer in today's market? Well, let's take everything that we've just talked about and make it real for you as a potential home buyer in this market. The reality is you don't control interest rates. You don't control inflation or the Fed or what Jerome Powell says next month. But what you do control is how you prepare. And in this market, preparation beats prediction every single time. If mortgage interest rates stay in the mid-sixes, it shouldn't be a deal breaker. That's just the cost of doing business right now. The thing is, you have to build your offer around it. You negotiate seller credits. While I'm not a huge fan of temporary buy downs, that could also be an option. And then ultimately you plan for a refinance if and when the opportunity comes. Not because you're betting on it, but because you're ready. As long as you sit on the sidelines and you think that prices are going to come down and interest rates are going to come down at the same time, unfortunately, I think you're setting yourself up for failure, because Logan has already proved once interest rates stay below that 6.6% number, which is where we are now, we actually have demand come back to the market. And if rates drop, let's say to the mid fives, things are going to get really crowded. And that's because the buyers who've been sitting on the fence, well, they're going to come rushing back. Competition's going to heat up. Prices are going to rise. And ultimately, inventory is going to tighten. But here's the thing, if you bought before that wave, now you're ahead of it. You didn't chase timing. You made a smart move early that got you the house you wanted on your term. And ultimately, that's how you win in a shifting market. And if rates just drift sideways, do exactly what they've been doing over the last year or so, then you move when the numbers make sense, not when the headlines make you feel good. You don't need the perfect interest rate. You just need to be comfortable with the monthly payment. In fact, it's something we say on the Educated Homebuyer podcast all the time. You hope for 5.5%, but you got to qualify for, say, 6.5%. That mindset alone puts you ahead of 90% of buyers out there. So let's wrap it up. The NBA says, play it steady. Barry Habib says, real improvement is coming. Logan says, follow the data, not the drama. Well, Powell, he just gave the clearest signal yet that the Fed is shifting course. But here's the thing. None of them can tell you exactly when it all plays out. So your job isn't to time it perfectly. It's to make a smart move based on your situation, your budget, and ultimately your local market. Because despite what headlines say, there's nothing in the data right now pointing to a crash or a big drop in prices. Inventory is still tight in most markets out there. And we all know demand picks up when interest rates drop. So it's important to remember real estate is local. So what's happening in your zip code matters than what's trending nationally. So stop waiting for the perfect timing. Start focusing on a strategy that actually works for you. If you want help figuring out what that strategy looks like, make sure you reach out. Use that link in the description of the video. It'll actually get you in touch directly with my team, whether you're looking to buy, sell, or you just need a plan. My team and I are here to help you make sense of the market and ultimately make more confident decisions. If you got any value from this, make sure you hit the thumbs up. It helps more people find the channel. And make sure you subscribe if you haven't already. I try to break this stuff down every single week so that you stay ahead of the market, not behind it. Lastly, I appreciate you watching. Adios.